Homeownership is looking further out of reach for anyone without family wealth. As over the last few years, property prices kept growing. I'm sure they're quieter a bit this year, but over the last decade or so, property prices kept growing and wages just failed to keep up. Now, sure, the markets have experienced a slump recently, but affordability seems to have decreased as interest rates keep increasing. Back in the early 1990s, house prices hovered around the mortgage you had to take was 2.5 times household disposable income, but now the same metric comes to 5-6 times household income. Now, up until last year, years of predominantly falling interest rate rises have fueled a property boom. They allowed households to borrow more, to bid up prices, to use their rising equity to upsize to a bigger home or to buy investment properties. And at the same time, the supply of new homes just didn't keep up with demand. But now many first-home buyers say they can't afford a deposit or they can't afford the repayments. So is it really harder to get into property today than it was a number of decades ago? That's what I'm going to be discussing in today's show with independent financial advisor Stuart Wemyss. And even if you've already got a home, I'm sure our discussion is going to be valuable for you because it's going to help you understand what we believe is ahead for our housing market. So welcome to today's show.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
Even though property prices are a bit lower today than they were a year or two ago, with rising interest rates, lower borrowing capacity and inflation eating away at household budgets, many people are suggesting it's harder to buy a home today than it was years ago. They're telling us baby boomers don't really understand how hard it is. Well, my guest today, independent financial advisor Stuart Wemyss, believes it's actually easier to buy a property today than it was many decades ago. Now, I know some people listening to this are going to disagree, so I'm looking forward to hearing his views. Welcome, Stuart.
Hey, Michael. Great to be back with you.
Well, Stuart, millennials keep telling us buying a home today is far harder than when their parents got into the market because the rate of property price rises has soared and it's gone well beyond wages growth. Look, in the pandemic alone, we know that the median property price shot up 26% and in some areas even 40%. Yet wages, they really didn't grow much at all, only recently starting to creep up a bit. Stuart, at first glance, these arguments make sense, but is it more to it than that?
Yeah, I think there is, and it can get a bit irritating listening to people in their 20s tell you how difficult it is to get into the property market, and that older people like you and I, Michael, had it easy. So I thought I'd write a blog I thought I'd write a blog to kind of rebuke that, and maybe some people can use it in some dinner conversations to kind of shut them down a little bit. I don't know, but the real answer is that it was difficult for us and it's difficult for them.
I think, first of all, we've got to say we do recognise that it is difficult for young people. We've got kids. I've got grandkids. We understand the importance of home ownership and we do understand it's hard. So we're not belittling that. But, hey, it was hard nowadays too.
Oh, yeah. Prices, you look back. I bought my first property 25 years ago. I look back at the price and think, oh, my God, how cheap was that? So, of course, people, and I should have bought 10.
But it didn't seem cheap at the time.
Oh, no way. It wasn't cheap. It was super expensive and it was a big mortgage and it was a big commitment and, we had to make sacrifices and we couldn't go out to dinner very much, if at all, in those initial years. There was nothing easy about it, but certainly looking back now 25 years, you go, well, how easy was it? So, of course, I can understand younger people saying, well, it's so tough for us today, but it's tough for everyone. Even my parents, they borrowed 3.5 times income, which was a huge mortgage in the mid-70s. At the time. And even the bank manager apparently saying, you sure it's okay? You sure, and they didn't have a life. All their money went into their mortgage. It wasn't easy for them, but that property was much cheaper than the one that I bought 25 years ago. And I would have had the same perspective 25 years ago, looking back at my parents saying, well, how cheap was that? I've paid 10 times the amount that you did.
Yep. So let's look at some things that are different today that I agree with you, and I'll leave a link in the show notes to your great blog, but some things that make it different, in my mind, I agree with you, easier than it was in our day.
Yeah, so we can talk about some of the practical items like borrowing capacity and income. But before we talk about that, really access to knowledge is so much more empowering today. So again, when I bought my first property 25 years ago, I was a graduate accountant. I'd graduated for a couple of years, a little bit of experience, obviously okay with numbers, but didn't know anything about property, less than anything. I don't know what that is. And certainly knew just as much about mortgages and loan structuring and all those sorts of things. And we banked with CBA. We just went to CBA. They had a mobile lender. That was quite kind of convenient. They sent them out. We spoke to them and they said, this is what you can borrow and this is what you can do. And we sort of fiddled around in terms of asset selection and type within our budget. And the only good decision, well, we made a couple of good decisions, but the obvious good decision today is we were contemplating buying a property that had more accommodation but was on a busy main road, a South Road in Moorabbin, in fact, or something off the main road. And we thought, we actually never buying a main road, of course. So we actually made a good decision, but that was only just from random luck. So, but
That's
today,
logical today because of the blogs, the internet, the podcasts, but they weren't around. And in fact, it's not just the knowledge, but there was also not the core logic or prop track or Andrew Wilson's figures or SQM's figures where you can see what's going on. The keepers of the knowledge in those days were the local real estate agents because it was sometimes 3 months, it was often a year after the fact that in Victoria was called the Valuer General that would bring out the figures. So you had no real idea of what was going on in the market, did you?
And now you've got podcasts, you've got, as you said, all that market data. You can get on websites and compare various lenders in terms of borrowing capacity, or in fact, just engage a mortgage broker to do all the hard work for you. There's so much more available information. And so the answer, I solidified into one point. And the point is that really the first property you buy, and I'm pretty sure we've done an episode on this, the first property you buy is the most important, because obviously if you get that right and it appreciates in value, or you add value, or it just works really well for you from a financial perspective, it will leapfrog you into the second property and thereafter. And conversely, if you make a big mistake, you'll be worse off financially in 5 years from now, not better off. So all that information helps us avoid making a mistake. Whereas 25 plus years ago, the only way you could avoid making a mistake is if you knew someone that was really successful in property and you had access to their experiences. But most people didn't. Most people don't have that. And so it was really just through trial and error, which is a really expensive way to learn.
Interestingly, in those days, because there wasn't as much knowledge about what's happening in the market, you didn't realise you made a mistake till quite some time down the track also, because you didn't have weekly auction results, monthly median house price figures to see what's going on. I fully agree that there's so much more knowledge and information, but interestingly, the statistics seem to show that still around 50% of people who buy an investment property sell up in the first 5 years. And the tax office tells us that it hasn't changed for a number of decades, that the majority of investors, 92% or so, never get past their second property. So it's still interesting that people are either getting their information from the wrong people or getting the wrong advice or making poor decisions. So I think one of the other factors that has changed over the time is there are more people to get good advice from, which is good in some ways, but it's also hard sometimes to work out who you should get advice from.
Yeah, it is. Sometimes too much information is actually exactly that. Too much information because you've got to decipher which bits to listen to. And the other problem as well is if you have a whole bunch of opinions on the internet, which opinion is correct, which is why, we've spoken about it before about evidence-based strategies. My argument to that or response to that isn't that you're not listening for opinions or people to follow. You're looking for methodologies to follow, and that there should be enough evidence to demonstrate that methodology works and it makes sense.
Over the long term.
Yeah, exactly right. So I think that's really the approach, but there is just an abundance of information. And so I would argue, paying for professional advice is always cheap because the advice should make you a whole lot more money than it costs you. But getting a good foundation of knowledge is a really great start to avoiding making a mistake.
One of the other things that's changed a lot is the ability to borrow money, borrowing capacity. When I first started investing, and it was longer ago than you because I'm older, it was in the early 70s, so it was 50 years ago. You went to the bank because there weren't mortgage brokers around. You couldn't swap banks often either, Stuart, because you had to have had a savings record with them. So you didn't even have a lot of option to go to different banks. And it was only around then that they started to introduce your wife's income as part of your borrowing capacity as well. So you went in, and I had to put a suit and tie on, and you sat in front of the bank manager who made decisions, and they regulated how much they could lend as a percentage of the loan-to-value ratio, but also as a multiple of your income. It's changed over the years, hasn't it?
I mean, it's changed a lot with deregulation in the 80s of the banking industry. And then really Aussie home loans in the early 90s brought in a lot more competition and really disrupted the banks, which at the time were making about 4% on home loans in terms of gross profit. That today, and in fact hasn't really changed for about 15, 20 years, is about 2% now. So they really brought a lot more competition into the market, and as a result, interest rates became more competitive. But if you can't compete on interest rates, what else can you compete on? Well, product and features and borrowing capacity are other things that you can compete on. So, if you look at how borrowing capacity has changed since the 80s, back then in the 80s, you could borrow somewhere between 2 and 3 times your gross income. Today, it's maximum is somewhere between, say, 6 to 9 times. So really, borrowing capacity has tripled over that period of time. Now, the counter argument to that is, okay, Stuart, that's fine. Of course, I've got more borrowing capacity, but I need more borrowing capacity because property prices are so much more expensive. Yes, of course. I'm not arguing that property isn't more expensive and that eventually maybe one day you've got to repay that loan. It's really about ease of getting into the market, though. This is the argument that we're trying to make in terms of ease to get in the market. And my flip side, so counter argument to that as well is, okay, yeah, sure. If I, in the 80s, went and bought a property for $100,000 and went up 10%, I've made $10,000 in terms of equity. If I go and buy $1 million property today, because that's kind of, if I want to buy in a good area, that's maybe what I need to spend, and it goes up 10%, I made $100,000. So certainly there's a positive consequence of spending more on properties from a dollar value perspective. If you hold that property for 10 plus years, it's not hard to make $1 million of equity, over that time period for most people in the property market, where it would have been very difficult to do that in the 80s. So I guess there's always a pro and con to everything.
In the meantime, inflation erodes the amount that you've got to pay back with your loan as well. So even though the dollar value is the same, its value has gone down a lot. Of course, the other big factor is that in the old days, and you couldn't borrow more than 80% of a property's value. But today, with lender's mortgage insurance, you can borrow up to 95%. And then there are a number of state government and federal government initiatives that are helping home buyers get into the market as well, with being able to borrow with lesser deposits, or even having the government as your co-owner.
Yeah, or even parents helping out with family guarantees. So letting their children use some of the equity in their property as security for their loan, which is a really powerful thing to do, if parents are comfortable doing that. We've been doing them probably for 20 years now, and we haven't had one last longer than 5 years. So normally within a 5-year period, you can release the guarantee because you have enough equity in the property by itself. So it's not forever, and it's a great way to get kids or younger people into the market, because deposit tends to be the limiting factor.
Now, you said we've been doing it. So for new listeners who don't know what Stuart does, the team at Pro Solution Private Clients, while you're an accountant and you're a financial advisor, your team also provide mortgage advice for clients. So I think understanding all this and knowing how to take advantage of the various options gives your clients an unfair advantage.
I hope so. Yeah, we hope to inspire clients to adopt a holistic approach to building wealth. which means that understanding that most decisions are multifaceted, and even buying their first property is multifaceted. There's some financial planning, borrowing capacity, risk, insurance, taxation considerations, and to have one team look over all of those matters and give us succinct and considered advice at the end of the day, and do that over a period of time. If we have a relationship with the client for long term, I think make sure that all opportunities are maximised and risks are minimised. So,
now, some first-home buyers are going to be listening to this, Stuart, and they're going to think, oh, he's a highfalutin Melbourne City guy. Are you still happy for first-home buyers to contact you about getting a mortgage?
Yeah, to us, it's about the lifetime value of a client. So how can we work with a client over time to get them from A to B? And in fact, some of those experiences are really the most rewarding. Clients that we met 20 years ago that, just graduated and just started work and so forth are now in a fantastic financial position. Of course, we don't take all the credit for the outcome, but we know we've had a good hand in guiding that client and making great decisions. So that's the most rewarding part for us is
I'll
enjoying
leave a link
that
in the show notes so people know how to contact you. Now, also link to this great blog, because one of the concepts that you suggested that is very different today from the past was our higher earning capacity and more employment opportunities, Stuart.
Yeah, this one's hard to quantify. I looked at what I earned when I first graduated. I even had a conversation with my dad to see what he earned when he went and borrowed a lot of money to buy their first home. It is a bit hard to quantify. It doesn't really come through in the numbers too well either, particularly when you look at average time earnings and those sorts of metrics. And that's often the metrics that people use or the economists use to sort of make comment on how unaffordable housing is today. So my comments aren't related to everyone or to macro, but there's certainly a large cohort of younger people today that have a much, much, much improved earning capacity than what I certainly did 25 years ago when I started my career, and what a lot of other people have as well. And when you look at the mix, incomes excluding inflation for very similar positions, I looked at government roles, I looked in the private sector, in some industries have increased by half to 2 times. 50 to 100% they've increased. And really today, if you think about it, to for example, establish a side hustle, some sort of internet business or something you can do on the weekends or out of hours to supplement your income, that's super easy to do today. Well, I shouldn't say easy. There's always work involved, but in terms of learning how to do
there are opportunities available.
Yeah, and implementing it, a lot easier to do today than 25 years ago. And then if you think about, work from home and the greater acceptance of that, well, then now as an individual that has a career, I can not only think about what are the job opportunities in my domicile state, but even interstate or even international. And it's quite possible that it doesn't suit every industry, but it's quite possible I might be working for a company that's not even in Australia, and I can expand my earning capacity that way. So I think the same sort of thing with buying property, the information on the internet and accessibility and ability to even go to interview for a job in New York, for example, is a lot easier today than what it was previously.
Sure, with the increased acceptance of working from home, that makes a difference. I think what you're saying is that we've become more a knowledge-based society, and so therefore the average person, not everybody, is actually earning more than when we were more working with our hands, or a manufacturing society, or going back a century and we were working on the land. So yes, there is a higher earning capacity and clearly more earning opportunities. We were talking about information. I think one of the things that the younger generations are more aware of and have got more options is about budgeting, about cash flow, about management. Those things weren't spoken about when I was young.
No, and it was really dependent on how open your parents were about talking about their finances when you were younger, and that would then inform, how well you were going to do it as you became an adult. But it used to be, a bit of a taboo subject, talking about money at home, which isn't very helpful. But I mean, the great thing is that you do have access to those tools. And so really for people that are trying to get into the property market, the number one thing they need to maximize not only their knowledge and making sure they buy the right asset, but really borrowing capacity is the number one thing. So the way that you can maximize that is maximize your income and minimize your expenses. And so we've talked just now about maximizing the income piece, but then minimizing expenses will do two things. Firstly, it will prove to the lender that you can afford the loan, that you show what your minimum expenses are. And secondly, and most importantly, it will prove to you that it's the right thing to do. So we know that if we go and take a mortgage and we have that mortgage for 20 years, there's going to be periods of time where interest rates are low and periods of times where interest rates are much higher, much like today. And so long as we can kind of weather that storm, even though there's going to be some periods where it's going to come very tight and we need to make maybe lifestyle decisions that we otherwise wouldn't want to make, like we won't go out to dinner tonight because, we've got the mortgage repayments. That's okay, because in the longer term, it's all about building wealth, but you want to know that you're able to make those decisions. So by minimizing your expenses, particularly for a 3 or 6 month period prior to getting into the property market, is a great way to sort of prove to yourself what is the minimum that I can spend in order to not make any compromises that I wouldn't otherwise want to make. Yeah, so budgeting and learning how to manage money, really fundamental and really important to get right from the beginning.
Now, we're talking about, is it easier or harder to get into the property market today than it was decades ago? One thing in the past seemed to be buy your home first, but a lot of people are rent vesting now. They realise that they can't afford to buy where they want to live, so they rent where they want to live and buy in another state. And that's changed. It's much more accessible today, isn't it, Stuart, than it was years ago?
Yeah, and I guess because of that information and knowledge, the general wisdom was always, buy your home first, but it doesn't always make good financial sense to do it in that order. And so I guess it really does highlight, the benefit of having that information and really making the best decision, knowing that unlike 30, 40 years ago, it's unlikely that the first property you buy will be your forever home. So then and because property is more expensive today, quite often we might need to get to our forever home in 2 or 3 or 4 transactions. And so we then know the first transaction's not going to be the forever home. So what do I need to do in that first transaction to get me to the second, and the second to the third, and the third hopefully then is that forever home. But it's that kind of leapfrog aspect to making really good property decisions so that you can get there whilst not overextending yourself debt-wise.
Well, one of the ways that it's easier to buy in a different location nowadays is buyer's agents. We were amongst the first buyer's agents in the early 2000s. There were 2 or 3 others in Melbourne. Now there's lots of great professionals all over Australia able to help. So if you are looking to buy your first property interstate, you don't actually have to physically go there and see it, but you've got to have somebody on your side who's doing that. But I would suggest it's got to be somebody who works and specialises in that state, not somebody who just flies in and out. Now,
you make a good point there, Michael, and I'm not saying this just because you're on the other end of the call, of course, but the longevity in a business, I think that's super important. So if I'm getting advice from an accountant, a financial planner, a buyer's agent, what I want is access to their experience. And knowledge, but knowledge, is you can replicate knowledge relatively easy. So knowledge is part of it, but mostly it's about experience.
Perspective,
yeah, exactly right. And experience tells us how to apply the knowledge. So you and I have been doing this for a long time. We've seen lots of different markets, lots of different changes and all these sorts of things. We know how to navigate the next change that's coming our way. And so that's the experience that we hope to share with our clients. If you're going to use a buyer's agent, ask them about their experience and the firm's experience, because if they've been doing it for 20 years, they've got heaps of experience. If they've only been in the market for a couple of years, then what are you really paying for? That's what I'd say.
You're paying for their education. You don't want them to learn on you, though.
Yeah, that's right.
Now, Stuart, we've said lots of things that have changed to make it easier, but what we haven't pointed out too much is how much more expensive properties are today. So my question to you is, do all these positives offset higher prices?
Well, it depends on how much value ascribed to knowledge, which I think is substantial. But if we look at property prices, median house prices in Melbourne and Sydney, obviously they're the two key kind of capital markets. They've increased, excluding inflation, 4.5 times since 1980. So pretty considerable. If you look at a conservative estimate of borrowing capacity increase, so just assuming that incomes have increased 25-30% in real terms over that period of time, some sectors they've increased a lot more than that. That borrowing power has helped you increase your affordability by about 3.5 times. So there's a small gap there of a 1 times difference that knowledge needs to make up. That's up to people to draw their own conclusions, but I would say the knowledge and access to data and all those sorts of things help us buy a better than average property to a much larger extent. And I'd say that makes it easier to get into the market and avoid making a mistake. So it's true, house prices are more expensive. It is more expensive to buy property. If I go and borrow the full cost, I've got to eventually repay it. So there's no argument there. I'm on the hook for a bigger commitment, but it's about getting into property and then secondly, building wealth through property. And I think that is easier to do today than it was 25, 30, 40 years ago.
Because of the information and the ability to make the right decisions. So maybe just wrapping this up, sure, it's challenging for first home buyers today. It always has been. So rather than complain about it is harder, it is easier than in the past, just see what's going to happen in the future, understanding the underlying fundamentals that are going to underpin the long-term property price growth. Now, we know there are some headwinds in the market at the moment, things like our economy slowing down, inflation, rising interest rates, talk about the mortgage cliff, which we're going to be discussing. In fact, we've already discussed that in the last podcast that we've done about what to do if interest rates are going to be a change in interest rates are going to affect you. But having said that, what you've got to understand is Australia's population is growing. We're not building enough properties. Our economy overall is doing well. So you've today got more ability to make the right decisions, get a good team around you to build wealth through property. And if you do that right, you're less likely to make mistakes because, boy, those mistakes can be costly, Stuart.
Oh, exactly right. I've made a few property mistakes when I didn't have access to all that information in my past. For example, that very first property that I purchased, what I actually should have done is just pushed myself a little bit further financially, and I could have. And instead of buying in Moorabbin, I could have bought in Bentley. And the result,
other side of the highway makes a big difference, doesn't it?
Makes a big difference. And, the result would have been maybe another couple of $100,000 in that earlier years would have really, I'm going to use the word change my life. Money never really changes your life, but, it would have helped substantially. So that just one knowledge step, actually cost me a bit of money, but hopefully I've made up for it.
Well, I hope our chat with two older people, I'm older than you, just will bring some perspective. And rather than arguing, is it more expensive, isn't it more expensive, forget that. If you've got the financial capacity to do something, don't worry about getting the timing in the market right. Don't worry about all that advice on the internet that says our property markets are going to crash. Get good sound advice, get a good team around you, and get into the property markets, because when you look back in 10, 20 years' time, when you're in the position Stuart and I am, you're going to think, boy, that was easy in those days. Boy, that was cheap then.
Yeah, exactly right. But we find it hard. As human beings, one of the things that we find hard to do is get our head around numbers that are exponential. And I do too. Like if I say to you today, here's this property, this single-fronted house in Hawthorne that's worth $1.5 million. In 20 years, that's going to be worth $6 million. You would go, oh, come on, $6 million, you could buy like a pretty good house in Toorak that's, on a really large block of land. And Stuart, that can't be. Well, the answer is it's difficult to get our head around those numbers, but the reality is that's how markets behave.
Well, part of that, of course, is inflation. And even if inflation only increases at the 2 to 3% that the government wants it to and not the large numbers it has been, that alone is going to mean that property values are going to go up 20% over the next years. Stuart, thank you very much for your time. Now, I'm going to leave a link in the show notes for this blog if people want to read it. Also about Pro Solutions, because we explained that you offer a holistic group of services to clients. But just quickly again, maybe you could explain how you help people in the property and the finance world.
Yeah, we take a holistic approach and inspire them to take that holistic approach and build those longer term relationships. And if people are interested, just Google Pro Solution or in fact Investopoly, which is the blog and podcast that I run, and that'll give people a bit of a flavour for how we think and how we approach different things. And if that resonates, then they can get in touch.
Well, I love getting your blogs every Wednesday and listen to your Investopoly podcast every week as well. So I'll leave links in the show notes and we'll catch up again real soon. Thanks, Stuart.
Fantastic. Thanks, Michael.
I hope you enjoyed my chat with Stuart. And in a moment, I'm going to share with you my mindset message. But I hope you understood from our chat that we can see some headwinds ahead for our property markets, but we're both very comfortable with the long-term fundamentals, and then our property markets are going to do well. So while they will create significant wealth for many Australians, statistics show that 50% of those people who buy an investment property sell up in the first 5 years, and I can't see that being different moving ahead, where our markets are going to be very fragmented, and the market's just not going to work like it did a couple of years ago where all properties go up. But it's also over the years been shown that of those who stay in the investment game, 92% never get past their first or second investment property. So I guess the point I'm trying to make is that while property is a way to wealth for some Australians, attaining wealth doesn't just happen. It's got to be part of a well-executed plan, which in my mind is bringing your future into the present so you can do something about it now. But buying a property isn't a plan, isn't a strategy. You've got to start with the end game in mind, understand what you need, what you want to achieve, and then build a plan, a strategy to get there. And at Metropole, we have got frameworks that help our clients outperform their averages. Our clients are more likely to be in that top 1% of investors than average Australians, in fact 7.3 times more likely due to a recent audit, because we help them plan, and the property they eventually buy is the physical manifestation of a whole lot of decisions they've made, and we've helped them make in the right order, because property investment's a process, not an event. So whether you're a beginner looking for a time-tested strategy to make sure that you don't make the mistakes others make, or if you're an established investor, maybe you're stuck, maybe you want a second opinion, an objective opinion, or maybe you just want to get to the next level, I suggest you allow my team at Metropole to help build you a personalised, customised strategic plan. Of course, we want you to buy properties. By the way, we don't sell properties. Of course, we want you to build a portfolio, but we suggest you start with a plan. So go to metropole.com.au, and when we help you plan, you're going to define your goals. You're going to see whether they're even realistic, because for some people, the right answer is not to do anything just yet. If you're already an investor, we'll measure your progress towards your goals and see whether you're heading in the right direction. We'll find the way to maximise your wealth creation through property, but just as importantly, we'll help you identify risks. Some of them you hadn't even thought of. Go to metropole.com.au. I'd love to be part of your ongoing wealth creation journey.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
In today's mindset moment, I'd like to read to you an article written many, many decades ago by Jim Rohn. But some things just don't change. And his discussion was about facing the enemies within us. He was really talking about facing our fears. And today the world seems to be bringing on challenges, worries, fears from all directions, doesn't it? But Jim Rohn has got a great lesson for us, because he tells us we're not born with courage, but neither are we born with fear. He says maybe some of our fears are brought on by our experiences, by what somebody's told us about what we've read or heard. Some of our fears are valid, like walking alone in a bad part of town at 2 a.m. But once you learn to avoid that situation, you don't need to live in fear, do you? Says Jim Rohn. Fear, even the most basic ones, can totally destroy your ambitions. Fear can destroy your fortunes. Fear can destroy your relationships. Fear, if unchecked, can destroy our lives, said Jim Rohn. Fear is one of the many enemies lurking inside us. Let me tell you about 5 of the other enemies we face from within, said Jim Rohn. The first enemy that you've got to destroy before it destroys you is indifference, taught Jim Rohn. What a tragic disease this is. Ho hum, I'll let it slide, I'll just drift along. Here's one problem with drifting. You can't drift your way to the top of the mountain. Now, the second enemy we face within, according to Jim Rohn, is the enemy of indecision. Indecision is the thief of opportunity, of enterprise, said Jim Rohn. It'll steal your chances for a better future. Take a sword to this enemy, said Jim Rohn. The third enemy inside us is doubt. Sure, there's room for healthy skepticism. You can't believe everything nowadays, can you? But also, you can't let doubt take over. Many people doubt the past, they doubt the future, they doubt each other, they doubt the government, they doubt the possibilities, they doubt the opportunities. Worst of all, they doubt themselves. Jim Rohn said, doubt will destroy your life and your chance to success. It'll empty both your bank account and your heart. He said, doubt's an enemy, go after it, get rid of it. The fourth enemy Jim Rohn warns us about is the enemy of worry. We've all got to worry sometimes. Just don't let it conquer you. Instead, just let it alarm you, said Jim Rohn. Worry can be useful. If you step off the curb in New York City and a taxi's coming, you've got something to worry about, said Jim Rohn. But you can't let worry loose like a mad dog that drives you into a small corner. Here's what you've got to do with your worries. You drive them into a small corner, said Jim Rohn. Whatever's out there to get you, you've got to get it. Whatever's pushing on you, you've got to push back. And the fifth enemy Jim Rohn wanted to warn us about is the enemy of over-caution. It's the timid approach to life, because timidity is not a virtue, it's an illness. If you let it go, it'll conquer you, according to Jim Rohn. Timid people don't get promoted, they don't advance and grow, they don't become powerful. You've got to avoid overcaution. Do battle with the enemy, do battle with your fears. So Jim Rohn teaches us to build your courage, to fight what's holding you back, what's keeping you from your goals and your dreams. He says be courageous in your life and in your pursuits of things, in pursuit of the things you want and becoming the person you want to become. Some great words of wisdom from one of my mentors, Jim Rohn. Well, thanks for spending the last little while with me, and I hope you got some benefit from this show. If you did, and you know somebody else who'd also benefit, please tell them about the Michael Yardney podcast. There's a share button on every podcast app. On Apple Podcasts, there's 3 little buttons down the bottom. Press it and share it, or just tell them about the Michael Yardney podcast. I hope you're going to be doing them a favour, and you'll definitely be doing me a favour and helping me in my quest to make as many people as possible financially literate. Now, there's ways of catching up with me between these shows. Just look for Michael Yardney on social media, or why not join my private Facebook group? Go to Facebook and look for the Property Update Facebook group. And I have a way of saying thank you to you for subscribing to this podcast. Go to podcastbonus.com.au. There'll be a link in the show notes, podcastbonus.com.au, where you can get a bunch of ebooks and reports. My way of saying thank you. And when you've got time, why not listen to some of the old podcasts? There's individual lessons in each of those that I think would be helpful for you. I'll be back again real soon. In the meantime, have a great week. Make it a great week.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?